Welcome to your weekly dose of educational, unbiased, and unapologetic business and tax talk. It's time for Nailed It, the construction and real estate finances podcast. Let's hammer out financial opportunities and pitfalls with your hosts, Jeremy Bollinger and Ian Grove.
All right, welcome back. Here we are, Mr. Bollinger and Ian Grove, talking about basics of real estate investing. The basics of tax strategies for real estate investing. I think if you want to learn the basics of real estate investing, that's a different podcast. But this is a first part in the multi-part series. There's a lot of ground that we could potentially cover. Rabbit holes abound. But I think we'll probably end up coming back to some of these topics as we kind of progress and evolve down our happy little trail of discovery on this podcast. But let's talk about the opportunities inside of real estate. Let's talk about some basics here to make sure that we set the stage properly for everybody. And beyond just, I think, what everyone probably recognizes as real estate opportunities, which is investing in single family residences or your house. Can you give a more broad definition of like the opportunities that exist for real estate investing, and hopefully most of them are leverageable to a certain extent?
Yeah. I think I'll just throw it out there. I think we already have this disclosure. I'm not a registered investment advisor, so I can't legally give investment advice. Neither can you. That's why Ian said that. The one thing I will say about investing, all the good long-term investors, and this isn't an original idea, Warren Buffett and all the good ones out there, they have books. You have to understand the risk reward ratio before you get into any investment vehicle. It doesn't matter if it's real estate, stocks, bonds, options, commodities. Understand what you're risking for what you're going to win. So the basic first one, the easiest way to start investing in real estate is buy your own primary residence. Because if you live in your primary residence and it's your personal residence, you live there for 2 of the past 5 years, you can sell it and you don't have to recognize any gain up to $500,000 if you're married filing joint, or $250 if single. And for just breaking it down, gain, how does that calculate it? So gain simply is your sales price less any commissions or closing costs that you come out of pocket. So net proceeds. And then for the individual who are in his primary residence, then it's your purchase price plus any significant improvements. All right. I put a new roof on there. I put a new AC unit, a new deck, new windows, start categorizing and coming up with all that so that you don't shoot above that $500,000 amount. Now, if you bought one for $1.2 million and you sold it for 1.3, there's no point in spending all that time. Don't waste your time trying to gather all that information because you're under your $500,000 if you're married and $250 if you're single. No.
Let me just, I want to interrupt and highlight something because back in the day when I worked in operations for real estate finance, and a very common question that we would get that we always would defer to the tax professional, but it's, what are my capital gains? And someone would buy a house for $400, sell it for $500. And they're like, isn't $500,000 the number I got to be worried about if I'm married? And I think it's important for everyone to this might be below 101, but the gain is the difference between the purchase price and the sale price, whether that's positive or negative, and then any adjustments that you just mentioned. So it's the gain. So in that example, 400 to 500, the difference is 100,000. If you're married, you get $500,000 of exemption. It's the difference between the two, not the sales price. So go ahead.
Yep. The only other thing I was going to say was, no, you cannot recognize a loss. So if I buy my primary, a bunch of people this happened to when the housing market crashed back in 2008, have a house that, a lot of people didn't sell until they got back from being underwater. But if you bought a house for $750, sell it for $500, I can't take that as a loss if it's been my primary residence. Now, we can dive into the specific details for people if you do a house hacking. So you're living in part of it, and then you're renting out other parts of the home. Yes, you can do that, but you'd have to start parsing out and assigning basis cost to the portion used as the personal residence and basis cost to what's being used for the rental portion. Now, the reason why I've done that 3 times now. I think I've bought and sold 3 primary residences. to be able to take the 250 gain exclusion, single each time that it happened. Because if you think about it, if I'm able to do this every 2 years, and I'm allowed to exclude 250 of gain, that between federal and state, now obviously some states don't have a state income tax, but when you start getting to that level of income, you're in the highest tax bracket. So the quick and dirty is 50% taxes. So if every 2 years I clear 250 in cash and that goes in my pocket, I needed to have a W-2 paying job salary of 500. Simple math, 500 times 0.5 going to taxes leaves me 250. That's the way I like to do it. It puts quickly a bunch of cash in my pocket. And now I can take that cash and leverage it to start buying single family homes, to get into multifamily homes, to do RV parks, to buy a gas station, whatever. Because a lot of people, they will keep their primary residence, they move in another one, and then they will just rent that out. Well, if you do the cash on cash, or you look at your net cash flow for a month, and let's say you're clearing $1,000 a month, you're going to have to clear $1,000 a month for 250 months in order to get that windfall of cash I just got. And if I can get financing at the leverage ratio, right, the 20 or 80% loan to value, top of my head, and that's $2 million worth of loans that I can get, right? 250 divided by 0.8. That's
real estate,
right?
Easiest way to leverage.
So you quickly took a bunch of non-tax money, and now you can start building. Start building a real estate portfolio. And the reason why everyone likes real estate is, I'm just going to quote the movie. You and I both movie quotes, movie buffs. The founder, there's a quote in there. You're not going to get rich and wealthy by selling $1.25 hamburger. You get wealthy by owning the land that leases the building to the tenant. So that's the number one builder of wealth across human civilization, has been real estate and owning land and buildings.
True story. We had a client that owned a bunch of, what were they, Taco Bells or something like that. But the franchises were valued, like there's like 25 of them that they're combined. 25 Taco Bell franchises were valued at like $10 million total for all of them. But she also owned the buildings that they were in, and that was valued at like 36 or 40 million or something like that. The money's in the real estate.
Yep. And my math, so anyone that was listening, and my math was bad, 250 doing an 80% loan to value can get you a 1.25 million loan, because you only have to put down the 20% down payment. Okay. So that's kind of where I started. You don't necessarily have to start that way. A lot of people, depending on who you listen to, they'll tell you start single family homes before you move up in the multifamily. I would just say stick with what you want to know or do. And that goes for anything. Again, I'm not an investment advisor, but most good investors, they will stick and stay in one asset class, or they will be a momentum. They'll do a swing trade. They're doing large caps. They're doing small caps. They're not flipping back and forth, because they learn and understand the risks associated with where they're at. And that goes not with just asset classes, but in different jurisdictions. So my background and specialties are construction and real estate. And a lot of the times when we would see construction companies fail, it's because they were in Arizona and they tried to go to Minnesota, or they were in Arizona and they tried to go to California. And we won't talk about what we think of California or what I think of California, but I don't want to go do business in California.
Dude, I built a couple spec homes in Hawaii, and on paper, it looks like a great idea until like every geographic patch of dirt has its own nuances. And if you look like me, which all that means is I'm not from Hawaii, very obviously, you have to hire contractors. You have to hire the guys that'll stamp your pipe and wires. You gotta kind of know the right people in that zone. And they're either going to drag their feet, charge you more, or a variety of other terrible things that they can do while I'm paying interest at a bank for the money I'm using to build this house. So Hawaii is another interesting demographic, but like every piece of geography has its own unique set of nuances. And you're totally right. Like, that makes sense that if you go outside of where you got a learning curve again.
Well, even here, when we recently moved from Arizona to Asheville, North Carolina, and just that was different. Where here in Asheville, or I think it's just statewide in North Carolina, you have to put down two different types of earnest money. One is non-refundable. Unless the seller has committed fraud and they are withholding information from you that you prove, and it's very hard to prove from what I've not understood, from what I experienced, you don't get that money back. So I put in an offer. I have two different types of earnest money. One, I can get refunded, but after I do that earnest money and make that offer, unless I can prove that the seller committed fraud, I can't get that money back.
But I mean, they have to accept your offer, right? Like, it's not like they're not just taking a bunch of offers and they're like, hey, thanks for your money. Like, so they accept the offer, and then that's like auto, like, you better get your finance. Like, so wait a minute. So even if you don't get past the financing contingency, you have to cough that up no matter what. That's crazy.
Yeah. So the way the lawyer described it to me is, unless you can prove that they committed fraud, were withholding information, or there are significant issues that are identified during the inspection, anyone out there telling you not to get an inspection on a home, you're stupid. All it takes is for one investment that you do for them to have bad foundation, some significant termite damage. You are destroying your portfolio. So I'm just going to throw it out there. I've never bought a home, whether it's personal or investment, without doing, or a commercial property without doing an inspection. I think that's moronic. But
dude, even with an inspection, like when we bought this house, there's still stuff that is popping up that didn't show up on the inspection. So get a good inspection.
Yeah. So going back to that fraud, and then if there are things identified during the inspection phase that they refuse to fix that are legitimate. Okay, the patio is falling down. There's mold in your HVAC system that's blowing spores throughout your home, and it's causing you and your wife and your two dogs to get sick. Yes, that's what I had to deal with in this Asheville home. And even though that was on one of the first inspections, which somehow came its way to me, first inspection with a different owner, I talked to an attorney and said, unless you can prove that went to them and you have all those email records, you're wasting your time and money. Don't bother with it.
You might as well not put down more earners money somewhere else and just fix the HVAC system. Yeah.
Yep. And so that goes to the point where it's called the sunk cost fallacy. And I'm guilty of this sometimes, but you get into an investment, whatever it is. Let's say you do have a major foundation issue and they give you a number. Okay, if it still makes sense after that, all right, fine, I'll come up with more money. But investing, if it doesn't make sense, if now the facts and circumstances changes and it doesn't pencil out, well, shit, I'm not going to throw another $50, $60, $100,000 into it. Let's see if I can't sell it and get someone else to take it over from me, not illegally or being shady, disclosing that there is foundation issues. There's nothing wrong with that. You don't need to win every single time on every investment. That's why there's a book out there in the tenets of real estate investing, and there's not in real estate investing, and then there's a proper mindset of investing, I think is one of them, but various very good books out there. I don't get any kickbacks for referring these, but they talk about this, knowing the risk to reward ratio. If I'm risking $1 to make $2, I only have to be correct 66% of the time, or
yep.
But we're going off topic. So back to real estate. The reason why real estate has kind of blown up as the hot thing to invest in outside of crypto is as a result of Trump's tax law change, TCJA, Tax Cuts and Job Act, that went in effect September, I want to say it was after September 17th, 2018 is when you were allowed to do 100% bonus depreciation. Right after that, sorry, I was wrong, September 28th, 2017. So any assets put into service after that date through 12/31/2022 were eligible for 100% bonus depreciation if the asset was deemed a 5, 7, and 15-year asset class. So we're digging down into some weeds here. Why is that important? So with real estate, I can do what's called a cost segregation study and break out the various components of that building between windows, doors, flooring, cabinets, countertops, etc., because certain of those categories are eligible for 100% bonus depreciation because they fall into the 5, 7, or 15-year asset classes as identified by the IRS. Now, back up a little bit, right? Because this is an intro. Most times when you buy real estate, so a building with some land, you have to allocate some value to land. There's 3 different methodologies to determine that value. Easiest and quickest, look at the county assessor website, and they will often break it out to you. They'll say land value. You might see another one for land improvement, and then they'll just have improvements or dwelling or building. And I get this question a lot. You don't take, if they put $10,000 for land right there and you bought your building for $1 million, you can't allocate 10,000 to land. You got to do the ratio. So if they say it's 10,000 for land, 90,000 for the building, and they say the total value on the assessor website is 100,000, you just have to do the ratio.
Okay, so there's who publishes the ratio? Like, is it the assessor or is it the IRC?
The county assessors. So this is one way. Like if I go on the Maricopa County Assessor, Buncombe County Assessor, you name an assessor, most of the good ones. There's one in Florida, I can't remember, but they don't publish it, so you have to call in. And there was 2 weeks in a row where I had to call for different clients, but they both had property in Florida, and I got the same guy. And after the first call, he recognized my voice. It's like, "Oh, hey, is this Jeremy?" It's like, "Yeah, hey, man."
You're old boys by now.
Yep. But it's on the county assessor website.
Okay, so like in like a high cost neighborhood, like for example, I'm from Washington State, in the neighborhood that I'm from, like the land itself a lot of times will be more expensive than the building that sits on it. So I can't just there's preventative guardrails, I guess is what I'm saying, from me saying, no way, this land isn't worth $2 million. It's worth 200. The building's worth 2.5 or whatever, like that. There's guardrails.
Yeah. In general, you want to assign as little value to land because land you can't depreciate. And we'll talk about that in a second. Depreciation is a non-cash expense. But the reason why I say in most situations, you want to allocate as little to land as possible, and we'll talk about this on another podcast, is qualified opportunity zones. For those, another tax technique where you have to improve the value by 100%, but it's just on the building. So in those situations, if I can allocate less to or more to land and less to the building, I don't have to invest as much to increase the value significantly or substantially, whichever the word is that they use.
Yeah.
But traditional real estate investing, you're trying to assign as little to land as legally possible. I've seen tax returns where their CPA or tax preparer just puts 10,000 every single time or $1 every single time. And their response will be, well, I've been doing that for 30 years. I've never been audited. Well, I would argue, I don't do this, but I could go 95 miles an hour in a school zone. Just because I do it doesn't mean it's legal.
Yeah,
and
right.
2, doesn't mean that there's significant and substantial risk, right? All it takes is one time for there to be a school bus or a kid coming through or a minivan. And I know we just got dark there, but if I'm going 95 in a school zone, it's stupid.
Totally.
So first, easiest, quickest way, circling back, county assessor, just look at the ratio. If that one's not good, because kind of to your example, certain counties, they assign a lot towards the land. Whereas in Maricopa County, where I was born and raised, it's just 10% across the board. If you look up a building, they just make it easy. It's 10% to land.
Got it. Well, that's easy.
So that one, you don't like the valuation. Then the next easiest, cheapest way is to look at comparable land sales. So if you know a realtor, reach out to them, see if they can pull some comps for you real quick. They're a good buddy. All right, I'll buy you a 6-pack, buy you some pizza, or I'll get a little bit more expensive. I'll get you drunk for a night. And they should take you up on that offer. Question I normally get after that is, well, I have my real estate license. Can't I just do it? You can, But I would also shoot that off to a colleague and say, hey, do you think this is representative of my property? Are these comparable sales? So that the IRS, if you do get audited, isn't saying, well, you just picked the best case scenario for you. Because it would be in your best interest as that real estate agent on your own property to cherry pick and show the least the land as possible. So you're trying to get an independent person to agree or to set the value for you.
Like a conflict buffer kind of
Yes.
thing. You're conflicted if you're going to pick your own value.
Yep.
And same thing with like, hey, the land value is worth $100,000 here, even though that's way less than 10% if it was like the county you're from.
Yep. And then the final third option is just paying for someone to do a valuation for you. So getting a third party appraisal. Oftentimes those come with the property when you purchase it. Now, again, if the goal is to set the lowest value to land as possible, normally I will talk to, and I tell clients, talk to the third party appraisal doing it. Just like valuing a business, there's different methodologies to value a business, just as there's different methodologies to valuing the land. And you tell them, hey, I'm legally looking to assign as little value to land as possible. Here's my goal. Some of them will, okay, I'm not doing anything incorrectly. I can just weight more towards this methodology.
Right. Got it.
Again, not doing anything illegal. Tax evasion, illegal, end up in jail. And anyone that's a movie buff, Office Space, I don't want to end up in that kind of prison. I'm sure you don't want to either.
You're showing your O face to the wrong people.
Right?
Okay, so well, we're pushing past time, but to kind of summarize, like what you're aiming for there is the reason why you want to put value on a building and reduce the amount of value on land is for depreciation, right? I mean, you're trying to leverage, and what's like, just I think wrap it up with this, because we're gonna spend another episode on cost seg specifically, but like for people's reference, like just give a 101 version of what depreciation versus deduction is. I mean, I think depreciation is a kind of deduction, but like, can you explain that?
Yeah. Depreciation is solely non-cash. So I buy an asset. You can buy it 100% with cash, or you can leverage it. And whether we're talking GAAP or IRC, Internal Revenue Code, you have to capitalize those. And then you have to depreciate that over the useful life. GAAP, so for financial statements, generally accepted accounting principles, you can estimate that. Whereas the IRS they're not going to let people estimate, because if you allowed everyone to estimate, what are they going to say? Well, that building's not going to last 27 and a half years. It's only going to last 5. So if I'm in basic math, if I'm dividing 1 million by 5, it results in a larger number. Whereas if I'm dividing 1 million by 27 and a half, it's a much lower number.
Right.
Why did I choose 27 and a half? Well, residential buildings, 27 and a half, commercial buildings, 39.
Right. Right.
And so depreciation, non-cash, it's just my way of writing off that asset I had to put on the books and depreciate over 27 and a half years. Whereas a deduction is normally, for most people, cash I paid out the door. And we could dive down into the weeds between cash basis and accrual basis, but another topic for another day.
So just so I like, this is a question that I've always, I guess, in my head could wrap my head around, but like, if I buy a building for business use and I pay $100,000 for the building, that's $100,000 of cash out the door. Why don't I get a deduction? I have to depreciate that stupid thing over time. I don't get that deduction today. So like that to me has always been annoying, but I'm assuming that fits a certain theory of why the code is structured in such a way that, you know, it can always piss me off though.
Yeah. You're talking about the matching principle. So
yeah.
They say, all right, that asset's going to produce revenue for you for years. So we're trying to match the revenue that's going to be produced with the expenses so that you don't have a wave in your financials.
Fair. I mean, I guess the short-sighted thinking is, let me get a deduction now for like as much as possible. Forget about next year. But then when next year happens, and this is like the snowball effect that is super common. Next year happens, I'm like, dang it. Where'd all my deductions go?
Yeah.
But that's maybe another topic for another day. But
well, and the reason why it again, to wrap it up, why real estate investing went turbocharged and you have everyone on the socials talking about investing in real estate is, okay, you had TCJA that allowed for 100% bonus depreciation. It wasn't just bonus depreciation on new stuff. It was new and old. So previously you could only use bonus on new assets and it wasn't new to you. It was like brand new.
Right.
So now you could do 100% bonus depreciation, and the quick and dirty math is, say you buy a building, and we'll sum it up with this to put it in terms of dollars and what it can save you for taxes. Buy a building for $1 million. The building is in Maricopa County. I assign 10% to land, so 100,000. I can now depreciate that building, 900,000. Let's just say it's a commercial building over 39 years. I do a cost seg, and the quick and dirty, like safe harbor that I tell people, it's anywhere from 20 to 25% of that value can be broken out in the 5, 7, and 15-year categories. So let's just make it easy and call it 20%. That's 180%, 180,000 of bonus depreciation. And assuming you can take it, we'll talk about that later, but assuming you can take it and you're in the 50% tax bracket, that just saved you 90,000 in taxes.
Right. There's your immediate bang for your buck, so to speak, on what real estate can do for you just with tax savings alone. Forget about the income producing component there. And it is, I mean, that's one of the, to me and most of my peers, technically you can pay me for investment advice and I can give you advice. I'm an investment advisor, but this is not investment advice, but it's the most leverageable way to, I can't go and borrow $1 million with only $200,000 cash in my pocket for a margin account at Charles Schwab. Like, there's no way. I have to have 40. So borrowing on margin, I actually have to have the collateral in order to take a margin loan. So you can't use bank money to something that's not I guess like a static asset is what I would call it. You know, it's not like stocks go up and down, right? Like, it's just kind of the nature of how they function versus a home. And there's always going to be a home there, so that the risk is tempered for the bank. So you can leverage, and I can, instead of taking $200,000, if I'm earning 5%, for example, on my $200,000, forget about fees or whatever, but 5%, what is that? That's 10 grand. That's 10 grand a year, 5% on $200,000. Or if real estate's appreciating at 5%, which is aggressive, I think, but maybe 2.5 inflation, 2.5 appreciation, 5% on $1 million is $50,000. So there's quite a big delta there. Or, I'm sorry, that's a big spread to be able to leverage on an income producing or potentially income producing asset. So it's such a approachable way to build wealth, I think, for a lot of people out there, myself and yourself included, that knowing how to best take advantage of not just obviously the leverageability and the wealth building component, but now if you know how to structure your affairs in the right manner, and as long as you meet certain criteria, you can really take advantage of some of the tax benefits from real estate that I think mostly gets lost on people just doing basic, like, I'm going to buy a house every 2 years, live in it, move out of it, buy another one, live in it, move out of it, buy another one. That does work. That, of course, that works, but there's other things you can do to further your cause and increase your bottom line. So that's my Ian Grove final thought for the day. Well, I think we're well and over on this one, but I think that was a useful intro discussion on some real estate concepts, and we'll start drilling into each one of these categories. Cost segregation is such a big one. There's so many armchair warriors and social media that use it to get clickbait and stuff like that, but they never tell you how to actually approach it. Spend the time, learn about it, listen to Jeremy talk about it, and you'll be well armed and ready to take advantage. So, anything else?
I would just say, based on what little we were able to get through on the script, I'd say this was part 1, part 2 to answer some of the other questions and things that we just couldn't do in the amount of time that we allotted.
Yeah, we'll keep going on the basic stuff just to set the foundation, and then we'll talk about all the bells and whistles and big screen TVs and shit that go in your house after you got a foundation. All right, buddy. Good talk. We'll see everybody next time. Thanks for joining. Make sure you click subscribe. Peace out.
Thanks, everyone.